If you were looking to invest in a company, how would you assess its financial health? You might ask to see a balance sheet to examine the company's cash flow. Would you know how to make sense of it? Cash flow balance sheets tell far more about a business than net income. Today, we'll discuss the different categories of cash flow and how they are reported. There are three separate categories of cash flow used to record different business activities. All show cash inflows and outflows within their categories. The cash flow categories are operating, investing, and financing. Operating cash flow shows the relation between income from the sale of goods and services to the production of these same goods and services. Included in the sale of goods and services are expenses, also known as outflow. Operating cash flow shows income from the sale of goods and services as well as expenses, or outflow, related to the production of those goods and services. This category shows payments for taxes, employee wages, and suppliers. This is information that directly affects a company's bottom line, or net income. Income from the purchase or sale of long-term assets and loans is investing cash flow. It reflects investment gains and losses. Financing activities involve long-term equity and liabilities. Examples of this are money contributed by stakeholders in decisions to issue stock or pay dividends. It's about the flow of money between owners and creditors. Non-cash investing doesn't directly affect the cash flow for a given period of time, but it needs to be recorded on a balance sheet. One example: a long-term loan used to buy a long-term asset. But how is that information conveyed on a balance sheet? Those transactions are noted at the bottom of the cash flow statement. Accounting for these distinctions in cash flow offers a more complete picture of the financial health of a company. And now you know what to search for when you request a balance sheet from a company before deciding to invest.